financial statements are the first set to make an explicit and unreserved statement of compliance with the IFRS for SMEs. Then thirdly, St. Mike presents comparative information in respect of the most recent previous comparable period only 20x2. So that is it. So answer to case study 1 part B question. St. Mike should disclose extract from the notes to the financial statement for the year ended 31st December 20x3. So you should read like this. Note 3, transition to the IFRS for SMEs. That is, it should be the announcement and reconciliation. Announcement and reconciliation. So the transition to the IFRS for SME has resulted. These are the transition to. Let me put it down. The transition to the IFRS for SMEs has resulted to a number of changes in the report, in the reported financial statements. The reported financial statements, notes thereto, and accounting principles. Compared to what has been presented previously. So this is how it can go. And if you remember, it is also the so let me just put them down so that to aid you when you are preparing yours. So the next paragraph, before the adoption of the IFRS for SMEs, St. Mike, which is the name of the company, financial statement were based on jurisdiction X tax laws, that is previous financial reporting framework. Previous financial reporting framework. So the following explanatory notes to the financial statements describe the differences between the IFRS for SMEs and the previous financial reporting framework. For the reporting period. Ended at 31st December 20x2, as well as for the opening IFRS, for SMEs. Statement of financial position at January 1st January 20x2. So that is it. Then you can now go for the workings. Now this is the workings. You come here, we have reconciliation of equity at 1st January 20x2 and 31st December 20x2. Okay. So we start for 1st January 20x22, here 31st December 20x2. So you can put your notes number. Let me say here we have the previous gap. We have difference. Then we have the IFRS. We have IFRS for SMEs. Here, the same thing. It can't contain year, so let's do it year by year. We'll do year 20x3 separately. So previous gap, difference, and here we have IFRS for SMEs. Okay, let's go. You can hang the currency signal CU. It is currency signal. Okay. Note 3.8. We had inventories. So let me shift these things. Let me shift them. We had previous financial reporting framework. We have difference here. Then we have IFRS for SMEs. Currency signal CU. Inventories according to the previous. The closing inventory. I can pick them here. The closing inventory according to the previous is 4. I hope you can see that now. It's 4. Okay. Sorry, this is it. Closing inventory is 4. Difference is what? Difference is 6. So you come here. Old gap using LIFO method. We have it to be 400. The difference is 600. Positive difference. When we add together, we have 1000. That's just it. Then we do for December 31st, December 20x2. So the same thing. Inventory December 20x3. This for December 20x3. You can see. Remember the first 20x or December 20x1 is same as first of December 20x2. So January 20x2. That's why we use this. So December 20x2 is this. Closing the old gap is what? Is 2200. The difference is positive 1300. Positive 1300. So that's what we want to do. So we'll put it here. Previous gap gave us a value of 2200 as the closing inventory, and the difference is positive 300. If we add it, it gives us the IFRS value, which is 3500. So we have adjusted for the reconciliation of equity at 1st January 20x2 and 31st December 20x2. So the next thing we'll go for is reconciliation. We'll go for reconciliation. Reconciliation. of profit or loss for the year ended 31st December 20x2. So we come here, this is the notes. We have the previous financial reporting framework. Then we have the difference. Then we have IFRS for XMEs. So currency signal hang, currency signal hang, currency signal hanged. The next you have to bring is costs of sales. Cost of sales. What was the cost of sales in that year? If you look at it, the cost of sales, as you can see, for 20x13, 20x2, the cost of sales is, according to LIFO, they were using LIFO then, is 35,700. 35,700. That was the cost of sale provided using LIFO as at then. It's 35,700. So what is the difference? What is the difference? The difference is negative 700. Difference negative 700. So what happened when you add that? Give us 35,000, which is the cost of what? Sales. Using FIFO according to IFRS for SME. So gross profit we do not know, is an extract. So your note will now be inventory. Changes in inventory arises from the remeasurement of inventories. You must state what has happened of inventories from the last in, first out, which is a LIFO cost formula from the previous financial reporting framework to the first in, first out, first in, first out, which is FIFO method or cost method, cost formula used in accordance with the IFRS for SME. So we have reported the difference, and that is the final solution to that question for case study 1.